When the stock market is volatile, a segment that benefits is brokerages. The problem with buying a brokerage stock is that most have been commoditized. Think about it. All the ads that you've seen, they all say the same thing. Zero fee trade-in, a simple interface, and a free sign-up bonus. For this reason, I've stayed away from investing in this industry. However, today we're going to be covering one broker that's differentiated itself from others, and that is in offering global market access and at some of the lowest margin rates in the industry. This stock is Interactive Brokers. Interactive Brokers isn't some new trading app. No, it's been around since 1978 and was one of the first to bring algorithmic trading to the stock exchange trading floors. Its mission now is to bring the same technicals-friendly interface and serve as a gateway to the world's markets. Today, Interactive Brokers allows for trading on more than 160 market exchanges in 36 countries and 28 currencies around the world. Over half of their accounts are non-United States residents, and they are at 4.1 million customer accounts, up 32% year over year. This may seem like a lot, but they have just a fraction compared with Robinhood and Charles Schwab, so there's plenty of room for them to grow. Now, there are two primary ways that Interactive Brokers makes money. First is with commissions with every trade, and second is net interest margin. Commission, I believe, most of us can understand, which is for every trade, Interactive Brokers takes an upfront rate, say around 1/3 of a penny per share, and more if it's an options contract. Now, this may seem like a ripoff compared to this zero fee offered by Robinhood, but the difference is Robinhood makes money by payment for order flow, so they will sell your stock share to a market maker like Citadel, which will fulfill the order at a slightly higher share price, say around half a penny more. Overall, Interactive Brokers is cheaper, but the fee difference is minimal. It's less than a penny. So it really isn't insightful or impactful unless you're trading at high volumes, like an institution or a high net worth individual. Their second revenue stream, which is more lucrative, is net interest margin. Because of Interactive Brokers' best-in-class automation, they're able to offer the lowest margin rates in the industry and yet still be super profitable on these margin loans. Their rates are almost half that of Schwab and E-Trade, so a trader who leverages trades can maximize their returns by minimizing costs and going with Interactive Brokers. For those like myself who do not get involved in leveraging, Interactive Brokers can still benefit me by paying out interest on uninvested cash balances. Simply, Interactive Brokers will put this uninvested cash balance with a Fed-backed treasury bond and keep some percent and give you the rest as interest. As you can see here, the difference between the blue, which is what Interactive Brokers gets from the treasury rate, and the orange, which is their payout to the customer, is pure profit for Interactive Brokers. It is a watch out, though, that we can see in this chart that if the Fed continues to drop interest rates, there will be less revenue recognized from this path. Right now in 2024 and 2025, interest rates are high. But in 2021, when interest rates were near zero, customers were not keeping as much cash uninvested versus putting it in some CD or some other yield-generating instruments. So it's just something to watch out for narrative-wise, but I don't believe it will show up in the headline numbers since new account openings are increasing so fast and total balances are also growing so fast. Overall, lots to like about this stock. They're growing new users quickly at 30+%, with even faster growth in transactions. They have a strong competitive advantage in enabling exposure to global markets. And lastly, due to their other automation, they're highly profitable with gross margins higher than 80+%. Solid business. Let's now look at the stock to determine my 2030 valuation. Currently, Interactive Brokers trades at roughly a $107 million market cap with about $5.9 billion in revenue. The PE ratio is around 30, which is lower than the 47 PE of Robinhood, but higher than the 21 PE of Charles Schwab. For 2030, I believe that Interactive Brokers can grow this revenue from this roughly $6 billion number to $15 billion, which would be a 23% annual growth rate. This, I believe, will mostly be driven by continued double-digit growth in their new account openings, which in the past year has been 30+%. I could see this continuing growing at this 30+% as their offering is just so good, but net interest income will grow slightly slower with the Fed rate moderating to lower yields. Hence, 23% growth rate annually to a $15 billion revenue run rate. For earnings per share, I believe they will grow hand in hand with the revenue, maybe even slightly quicker due to the operating leverage with their automation. 25% growth rate gets us to a $6 per share for earnings per share. I do believe a 30 PE is a bit elevated if growth is only around 23%, so let's assume a 24 PE for a roughly 1 PEG ratio. Put all this together and we get a $244 billion market cap for 2030, over 2x returns from today's stock price, which does meet my 15% annual return threshold. With that said, let's run it through mine and John's framework. But before we do, please read the disclaimer in the notes below. We're not financial advisors and anything we say should not be considered financial advice. Also, if you like content like this, please help us out and click a like and subscribe as we aim to analyze the world's most innovative companies twice per week. Now let's run Interactive Brokers through my 5-point framework. From a leadership perspective, I give this a very strong. Their founder is 81 years old and retired as CEO in 2019 after leading Interactive Brokers for 45 years. Much of his roughly $80 billion net worth today is tied to his 75% ownership of Interactive Brokers stock. So as chairman, he has a huge financial incentive still for this company to succeed. Their current CEO has been with the company since 1991 and their CFO since 1987. This is a leadership team that has been with Interactive Brokers for a long time and will focus on long-term growth, not the quarter-to-quarter noise to pump up a stock to try to pump it up before leaving to another role. For valuation, I give this a strong 23% revenue growth the next 5 years with PE multiple that is lower than today seems doable, especially since they are growing their new user account quite quickly. For revenue and profit growth, I give this a strong. Their focus on automation from decades ago helps give them the best-in-class profit margins, which continuously can get better as more volume is traded on their platform. 20+% revenue growth is solid as well for a $100 billion market cap company. For large total addressable market, I give this a very strong. There are tons of low-cost brokerages. What sets them apart is their global access. As wealth grows across Asia, Europe, and Latin America, demand for a trusted, low-cost cross-border platform should expand as well as more people aim to grow their wealth through the stock market. It can provide decades of double-digit user growth for Interactive Brokers from this international cohort. For secular tailwinds, I give them a strong. With the GDP growth of the United States slowing down, there has been a realization that international markets could be a better opportunity in the years ahead, especially with valuations being much lower despite higher growth outlook in international markets. Interactive Brokers is hands down the best brokerage available to access these global markets and should benefit as more investors like myself look to invest internationally to beat the S&P 500. Overall, I am surprised, but Interactive Brokers has scored well on my framework. When John first brought up wanting to cover this stock, I thought to myself, not a chance I'd consider adding this stock, as the stock's already run up nearly 400% these past 5 years and trades near its 52-week high. I tend to buy when stocks are closer to its midpoint to level off some of the speculative euphoria. However, our valuation model shows, despite this run-up, that it can still return 15% annually the next 5 years, and it does have tons of growth ahead as it continues to attract investors wanting global access. Thus, I suggest that we buy a small quarter position of Interactive Brokers for a community portfolio. What do you think, Dad, as you look at the technicals and run Interactive Brokers through your framework?
Thank you, Scott, for that wonderful presentation and analysis. Okay, I'd like to do my analysis now for Interactive Broker, symbol IBKR. Okay, for first of all, the company fundamentals, the dividend is around 0.5%. The beta is 1.22, which means it's 22% more volatile than the S&P 500. The market caps are around 107 billion, and earnings comes out on January 20th, around January 20th. So for that, it's a neutral to positive because of the dividend, and earnings still far off. Okay, for the second one, for the earnings history, it's beat 3 of the last 4 earnings. And, like I've said in the past, the company gives the analysis their bids and stuff, their earnings, what they think it's going to be. So they should always be beaten. But anyway, for that, it's a neutral to positive because it's 3 of 4. Okay, for the next one is the financials. The net profit margin is 41%. The debt to equity is 0%. And the PEG ratio is 1.9. That's for the 3 to 5 year earnings. The P right now is about 32, and then the 3 to 5 year earnings projections around 16. So for that, that's a positive. But I did want to say that Interactive Brokers competitors like Robinhood, their net profit margin is 52%, whereas Schwab is 30, so 30% net profit margin. So Interactive Broker is right in the middle, so that's fine. So that's why it's a positive. Okay, for number 4, for the stock technicals, for the moving average, the 50 is above the 200-day. The 200-day slope is positive, and the price is below the 50 but above the 200. For the Bollinger Bands, it's hugging the lower band, as you can see. And then for the slow stochastic oscillator, it's at 12, which means it's oversold. And it did intersect an important line theoretically, so that's a good sign that maybe it's going to be coming back. The price is going to be going back up. So at least in the short term. And the MACD is negative, and the unbalanced volume is neutral. So for that, that's a neutral to positive. And then lastly, for the analyst coverage, there's 1 sell, 4 buys, and 1 strong buy. And the price target on one of the analysts is around 77. And institutions hold 84% of Interactive Brokers. So that's a neutral to positive. So overall, overall, Scott, I think that I'm a buy, a buy for maybe a 1/3 position because of the PEG ratio, no debt, and net profit margin of 41%. And also because of the slow stochastic oscillator to review, it's intersecting an important line. So theoretically, that's a good sign. That means that in the short term, it should be going up at least. So I'm a buy at a 3rd position buy, and then we'll see how it goes in the future if we buy more. But right now, it's a 1/3 of a position. So back to you, Scott.
Thanks, Dad. Long term, we both like the growth potential for Interactive Brokers to continue beating the market, driven by their new user signups. Short term, John mentions the technicals are favorable for a buy now. Thus, we will be adding a 1/3 position to our community portfolio. With that said, thank you for watching. Please hit a like and subscribe as we aim to analyze the most innovative companies twice per week. Until next time, happy investing.